A life insurance salesman will tell you whole life is an investment. He will show you a chart. He will use the words permanent and guaranteed and tax-free. And he is technically not lying, but the math he is leaving out is the difference between $100,000 and $350,000 by the time your kids are grown. Today, term life, whole life, and the trade you are actually being asked to make. Welcome to Fiscal Fluency, the language of wealth. Life insurance is one of the most aggressively sold products in personal finance. Let's translate what each version actually is, what each one costs, and which one is right for almost everyone watching. Term life is the simple version. You pick a coverage amount, say $1 million. You pick a length, 10, 20, 30 years. You pay a fixed monthly premium for that whole stretch. If you die during the term, your family gets the payout, tax-free. If you outlive the term, and statistically you will, the policy ends. You got nothing back. And that is the correct outcome, because term life is not an investment. It is a hedge. You are paying a small premium to transfer one specific risk, that you die while your family still depends on your income, to an insurance company. Once that risk is gone, you stop paying. That is the entire design. Whole life is a different animal. It is permanent, coverage for your entire life, not a fixed term. And it bundles two things together. 1. A life insurance policy. 2. A savings and investment component the industry calls cash value. Every premium payment splits. A portion goes to the insurance side. A portion goes to fees and the agent's commission, and what is left over goes into the cash value, which grows slowly at a guaranteed minimum rate, often around 2 to 4%, plus sometimes dividends from the insurance company. You can borrow against the cash value. You can in some cases withdraw it, and when you die, your beneficiaries get the death benefit, but typically not the cash value on top of it. The insurance company keeps that. The premium is the headline number. For the same coverage as term, whole life often costs 10 to 20 times more per month. That is the trade, permanent coverage and a slow-growing savings bucket for an order of magnitude more money up front. Here is the comparison that ends the argument for 95% of people. Take a healthy 35-year-old. A 20-year, $1 million term policy costs roughly $30 a month. The same $1 million whole life policy, same person, same coverage, costs roughly $700 a month. The difference is $670 every month. Now imagine two paths. On the whole life path, you pay $700 a month for 20 years. The illustration the salesman shows you projects a cash value at year 20 of around $200,000. On the term path, you pay $30 a month for the same insurance. Then you take the $670 you did not spend on whole life and you invest it. Index funds, in a Roth IRA or a brokerage account, at the long-run market average of 7%. After 20 years, at age 55, that invested difference is worth roughly $350,000. Same insurance coverage for the whole 20 years. $150,000 more in your pocket at the end. And the money is liquid, in your name, not the insurance company's. This is what advisors mean when they say buy term and invest the difference. It is not a slogan. It is the math. Whole life is not a scam. It is a product, and it has a narrow set of cases where it is the right tool. 1. Estate planning above the federal exemption, which in 2026 is $15 million per person. Above that, a whole life policy held inside a properly structured trust can pay estate taxes without forcing a fire sale of the assets. 2. A lifetime financial obligation that does not end at retirement, most often a special needs dependent who will need support after you are gone. 3. You have already maxed every tax-advantaged account. You have a specific permanent insurance need, and you have the cash flow to absorb the premium for decades. For everyone else, the people term life was built for, whole life is the wrong tool. There is a reason whole life is pitched at you and term life is not. Term life pays the agent a small commission, typically 30 to 90% of the first year's premium. On a $30 a month policy, that is a few $100s total. Whole life pays the agent a much larger commission, often 50 to 100% of the first year's premium, on a policy that costs $700 a month or more. That is $4,000 to $8,000 on a single sale, sometimes more. If someone is pushing whole life on you and they are paid by commission, you are not getting advice. You are watching a sales pitch. Ask if they are a fee-only fiduciary. The answer tells you everything. This is education, not financial advice. Premium quotes vary by age, health, state, and carrier. The numbers in this video are representative, not personalized. Get your own quotes before deciding. The investing side of buy term and invest the difference lives inside the Fiscal Fluency ledger. Subscribe for the rest.